and and basically have them in my working file. I have them in my working papers. And does that answer your question?
Okay, thank you.
Okay, cool.
Victor,
Yes, yes, Parrot.
there is some information that cannot easily be disclosed. For example, you gave us an example whereby when you realize that maybe the head of finance is not qualified, then you will know that there will be a lot of errors, therefore there is a risk there. So such information, as when you get to know as an auditor, sometimes it is hard to share the truth with people that you're really unqualified. Do you
Yeah,
first sugarcoat it, or you put it the way it is?
very interesting. That's a very good question. Now, when I remember right now we are still at understanding the entity. If, for example, okay, how I'm going to get this, of course, I'm going to maybe request for the organizational structure, get to know the people, like the key people in places of responsibility. Then I'm going to have to look at the personnel files like later and review them and see the qualifications. What have they studied? What have they achieved as per their CV? What does their profile look like? And when I notice that he's not qualified, definitely, I will know that that's a weakness in the what? In the internal control structure of the what? Of the organization. I'm definitely going to have to report this by the end of the audit in the management letter. I'm not going to come and say, hey, Victor, you're not qualified, so there's a risk here. No, no, no. I will take note of that at the planning, but I know that I have to make that part of the report or part of the recommendations that maybe there is need to strengthen their finance department, maybe by having a competent personnel in the department. That's like the sort of, like that's the approach. You will notice it here. It will come out at the end when you're making a what? A report. If I come and I'm understanding and I realize that maybe there's a lot of taxes that you're not complying with, I can ask you, discuss with you, like, what's up? Why can't you file the taxes appropriately? But I have to make a recommendation in the what? In the report at the end of the day. When I am reporting, or when you are reporting, you are not supposed to sugarcoat it. You have to put it there the way it is. Sawa.
Okay.
Okay. The nature of the entity. Now, the nature of the entity, of course, we are looking at the operations. What are the products and services that the entity is dealing in? Okay, so so you need to know what the operation that you're auditing does. You need to know the products that they do have, and that is going to have like a bearing on on some of the things you need to think about from an auditor's perspective. If, for example, I notice that maybe you're dealing in only one product, maybe that could be a risk. Okay, it could be a risk from a going concern perspective. Even the nature of the products that you deal in could be an issue. I could be dealing with a client, or I could be taking on a client who is dealing in illegal activity. Maybe they are doing money laundering in the economy. What does that mean for me as an auditor who is coming in? Then key customers and suppliers. Customers and suppliers, why you need to know them, it's because these are the guys who they make the business. There's a client I was dealing with sometime in the past. I think that was about in 2016, and they had a big receivable from NRM Secretariat, and this is an example for class, and it's a true thing. I'm sure most of you have seen it before. It's not political, not against NRM or something, but they had a big receivable of about, it was about something like over 120 million from NRM Secretariat. That was in 2016 after the elections. And, I had discussed with them and I'm like, hey, what's up? Is this money going to be recovered from NRM? So we're trying to get it. And, I'm saying, oh, is it going to really be a bad debt? I need to make a provision in the financial statements. And they said, oh, no, this money is going to be recovered. Then later in the evening, when I went back home, I saw on TV, I saw this Secretary General for NRM, Madame Kasule Rumumba, on TV saying that the party does not have money and they are struggling. They do not even have money to pay what? To pay salaries. So at the back of my mind, I was like, hey, but is this receivable in this particular client? It was a hotel setup. And I told them that you guys, because of what I saw in the news, I'm sure even you must have seen it or heard about it. These guys don't have money, they are struggling, and therefore you need to be making what? A provision in the what? In the financial statements. That is very, very important. Right now, we know that AfriCell has closed, okay? So whoever had a receivable from AfriCell, right now they should be thinking of making a provision in their financial statements. So those are things that you need to think about, the things you need to think about loud and know how these are going to be affecting your what? The financial statements. We had clients that had hotels as their main customers. All those right now are struggling because the hotels are no longer working at capacity like they were before. And of course, that meant that even these guys' business had to do what? Had to go down. Who had hotels as their main what? As their main customers. Now, when you talk about the suppliers, if your suppliers become bankrupt or they're not able to supply you, sometimes it could lead to shortages in your business and you won't be able to meet your customer demands and lead times and all that. So all those guys have a very big bearing on your what? On your business, and that's why you need to understand them very, very well. Employment contracts and labor laws. Of course, these are related to employees. Are there any bonus related pay, profits, what? If, for example, I am the CEO and I know that maybe at the end of the month, I take away a bonus of 2% of the net profit, I would be interested in making sure that that profit goes high. Okay, so if that profit, so I'm interested in overstating that what? That profit. You as an auditor, you need to know, are there any performance-based pays that may put pressure on top management to overstate the profitability? That is just a risk the way it is. If I know that at the end of the day, Peruth is the head of finance for ICPAU, and we pay her a bonus depending on how much profit the organization makes at the end of the year, Peruth will do everything possible to make sure that profit is high. She will understate those expenses and she will overstate that what? That revenue. So something like that, which is in the employment contract, actually poses a risk from an audit perspective. And you've got to think about how you're going to do what? How you're going to address it in the financial statements. Research and development expenditures. How are they spending on research? If they are not spending on research, it is a problem. The business is not growing. If they're not coming up with new products, unless you are dealing in a market which has no competition and it's only you they can buy from, or your business can never decline. Transactions with related parties, of course, this pose a risk from a tax perspective. And you need to keep an eye on them and make sure that it's not just transferring profits from one company to another, and you're not contravening any tax laws. And of course, we had talked about cash-based businesses, which bring about inherent risk in the what? In the financial statements, like cash being stolen, among others. So Any questions or comments before we proceed? Ownership. Ownership. I don't know if you guys have done consolidation before, or maybe you are about to do it. Those who are doing financial reporting. But we know that if you own more than 51% in company X, then your financial statements should be consolidated. So it is very important that you even understand the ownership structures within what? Within some of the companies. Otherwise, we are going to have company A owning 70% in company B, and then you find when they have not produced consolidated financial statements. Yet by virtue of their ownership structure, they should be consolidating. A consolidated with what? With B to produce group financial statements. So that is very, very important. Then, of course, investments made or planned acquisitions, divestitures, shares, loans, capital expenditure. You need to think about these. Are they planning to buy new shares? Are they planning to diversify their operations? Are they planning to take a significant loan in future? Are they planning to go public? You know, all those things have an implication. If I am company X and I'm planning to go public, maybe in the next 3-4 years, of course, by the time I list my shares on the security exchange market, I need to prove that I have been performing very well. So something like I am planning to go public, I am planning to list my shares on the security exchange market could actually put pressure on management and the directors to overstate the what? The profitability of the company. So that is something you need to think about. Otherwise, people are going to start misstating financial statements because of what they are planning to do ahead in the business. And you need to be very cognizant of that when you're doing what? When you're carrying out some of these audits. Then organizational structure. We've talked about the structure of the group and consolidation. Do we have investment in associates? Do we have NCIs, and are we treating them correctly in these financial statements? Then, of course, financing activities such as debt structure and terms leasing arrangements. I've already talked about borrowing. Borrowing comes with its own terms and conditions. If you breach any of those terms, there could be legal risks. Some people could just come and close down your business and take out their money. Imagine you had a loan of $3 million and you start not complying. The guys will just summon you and say, give us our money. And if you get that money and pay it out all at once, then you're out of business. So you need to think about some of those things as an external auditor so that you make sure that you're not missing anything. Then, of course, financial reporting, accounting principles, industrial practices. These are very good to be aware of, and they have an implication on these financial statements. Any comments or questions before we continue to objective strategies and other business risks? So when you talk about objectives and strategies, one, we have industrial developments. If the industry is changing, you might not have the expertise. I think we have seen some of the multinational companies bringing foreigners, especially in the construction and in the engineering space, bringing foreign expatriates to come and do what? To come and do some of the work here. It's because maybe the kind of business they are developing or they are running is a little bit unique, and you do not have the personnel and expertise to do what? To do it. And when, of course, when those foreigners come in, it has an implication. The costs are going to be high on the business, okay? And there could be a lot of tax implications in the area, and the better you understand them, the better you're going to address them. I know of one of the financial services institution in Uganda, it's an MDI, that was forced to chase away expatriates. The MDI was making a lot of losses, and the losses were being driven by a lot of money that was being paid in form of salaries to these guys who had come to work in the country from abroad. So the Bank of Uganda just told them, you fire this person, fire this person, fire this person, replace them with the local people who are going to earn less salaries. And yeah, you will improve on your what? On your performance. New products and services. When you bring in a lot of new products at the same time in the business, it can also bring in a lot of product liability, especially if you're making these products for yourself. If a new product is going to be launched in the market, it's going to fail. Some could even have side effects on the clients, and all those can lead to costs. The products, if you bring them on the market and they fail, like those that have warranty, you're going to have to spend a lot on warranty replacements. So from an auditor's perspective, if there's a lot of new products being launched on the market, then the auditor, you have to think about warranty. Are these products having issues or they are not having issues? If they're having issues, is the warranty provision in the financial statements accurate or is it not accurate? So you need to be thinking with sense number 6, not thinking across what is normal or what is expected by everyone. Rapid expansion of the business increases the risk of breakdown in internal controls. When the business is growing day by day, in some of the instances, we could have overtrading. Overtrading is where a business is trying to do more than it can do, more than it can manage, and that will come with a lot of negative consequences. You're going to grow the business very fast. You're going to miss some of the internal controls, and you're going to have a lot of what? A lot of issues at the end of the what? At the end of the day. Sometimes when you're over expanding at a high rate, it could also be possible that the expansion is just being overstated. It's just being exaggerated. It's not supposed to actually be moving like that. So what does that mean? That means that the expansion is being overstated, then we have a lot of issues from a strategic point of view. We could be overstating the expansion that is going to cost the business a lot of resources, and at the end of the day, the expansion does not work out. New accounting requirements, it's very obvious. The use of IT, depending on your strategy, the IT environment might actually do what? Might be changing. You might find yourself in a situation where the rate at which you're growing or the things that you are coming up with into the business are not compatible with your current IT system. So you need to make sure that there are no parts of the business that are being what? That are being broken. Any comments or additions before we continue? You need to understand the internal control structure, okay? The control environment, of course, it looks at the framework within which your internal controls operate, okay? I know we will look at it in detail in topic. In the next topic, when we are covering the internal controls, but you need to understand the control environment. You need to understand the risk assessment process. How does the entity identify business risks? How do they estimate the likelihood of occurrence and the significance of these risks? And do they have any measures in place to address them? You need to make yourself comfortable and used to this. Then of course the information system, which looks at the physical infrastructure, the hardware, the software, the people that are involved in the financial reporting process. If you have a proper information system, then it is going to make it easy to have accurate financial statements. But just imagine an organization without any sort of information system in place. Definitely the financial statements at the end of the period could actually be what? Could actually be misstated. And of course, the control activities. Those the things you do in place to make sure that there is no loss of what? Of any information, no loss of any asset, and no breakdown in the what? The internal control system. You don't understand the accounting policies. Of course, what are the accounting policies applicable for this organization? Has there been any changes, and have we had any new financial reporting standard and regulations? Because if I am dealing with an entity and I know that maybe this new standard actually affects them, then it is going to bring about, like, you're going to have to make sure that you address that. Like, we have had recent changes in the financial reporting framework. We've had IFRS 9 coming in that talks about impairment measurement for financial instruments. We have had IFRS 16 coming in, that's accounting for leases. So you need to be thinking about, are there any financial reporting regulations or accounting policies that have been issued from a regulatory perspective, or depending on the financial reporting framework your client is using, that have an impact on this organization? If they are, then there's a big risk, because most of the times when accounting requirements are being introduced or are being brought on board, there is this whole bit of people do not understand them yet, people can misinterpret them, and the financial statements can end up being what? Misstated. And therefore you need to be on top of your game when it comes to understanding of the accounting policies and how they should be applied and how they should be adopted by these organizations. Then financial performance, we've already talked about this, but how we measure financial performance in an organization might put pressure on management to overstate or understate some of these metrics in reporting. There could be financial indicators or non-financial indicators, or how do we analyze our reports when it comes to budget versus actual analysis? How does that sink in? How do we manage the employee performance measures? And then of course, how do we compare with other people that we are with in the what? In the business. Okay. Also, if we do not have any way of measuring performance in an organization, it's also a very big risk, because we just don't care about anything. And because we don't care about anything, we don't even know what is good, we don't know what is bad, and it could even be as bad as leading to a going concern risk in this what? In this organization. So, do you have any questions or comments or additions or experience shares on that?
So like if an whatever performance is not done, should that really be a risk? If at the end of the day, the financials are produced and they are all okay?
Remember, here we are doing risk assessment, okay? So if I come and I find that you do not have any way of measuring performance, it shows me that there's a risk A, there's risk B, there's risk C as an auditor. But it does not mean that the financials are actually materially misstated. Let me use an example of the qualification of the head of finance. We know that there are very many good accountants who are not CPA qualified, but they are good at what they are doing, okay? I could find when your head of finance maybe is not a qualified accountant, as an example, okay? But the guy is good at what he's doing and he can actually get everything correct, okay? But that does not erode the risk, because remember, at the start, I have not started the audit. I'm just trying to understand the environment and assess the possible risks. I just have to have it at the back of my mind that the risk of error is high, but when I come to audit, I am going to verify that. So likewise, this is basically to guide you. There's no way of measuring performance. This is the risk I anticipate. This is the risk I anticipate. But it could actually be that even when I come to validate the financial statements, there's actually no problem. There's actually everything is fine. So does that answer your question, Dennis?
Yes.
Okay, great. So there's many other things that we can encounter or that we will look at in some of the examples that we will look at. So, of course, the whole point of you doing this risk assessment, you need to assess the significant risks and the things that sometimes you have to consider, things like fraud, risk of fraud. You have to make sure that you assess that and you address that when you're carrying out your audit. Recent major economic, accounting, or other developments, we have talked about that. Are there any complex transactions? You need to think about this. Big transactions with related parties, you need to think about this. Subjectivity in measurement of financial information, e.g. accounting estimate. There are some of the things that really stand out when you're doing your risk assessment. And then of course, big transactions that are outside the normal course of the business. If I am a school, for example, and then all of a sudden you see me importing a tractor, it might not make what? It might not make meaning. What exactly am I doing and why am I doing it? Those are the transactions that we might say, or that we can say they are outside the normal course of the business. There could be things that might appear unusual in the business. Procedures, how do we do this risk assessment? Inquiries from management. These things you ask, the things we have looked at above, the things we have talked about, some of them you will get to know them by making inquiries. Inquire from directors. These are the guys who are charged with governance or running the organization. Ask them and get to know each and everything about the organization. You can inquire from internal audit personnel, because these are the guys who work closely with this organization from an internal audit point of view, and they could have a lot that they can help you when you're understanding the entity. Entity lawyers, they will help you to things to do with compliance, product warranties, any court cases. And then of course, marketing personnel is the guys who have hands-on information when it comes to dealing with customers, strategies, and sales trends. You can inspect documents and assets. Some of the things we have talked about above that you need to understand, you need to inspect. If you want to look at the business strategies, look at their plan, look at their strategic plans, look at their business plans. Organizational charts, accounting manuals, they will have all the controls, monthly, quarterly management reports, financial statements, budgets, minutes of directors, meeting. All those things are going to give you an understanding of what the organization has. Like meetings of directors are things that are going to be talking about bonus, performance-based pay, how do we measure the performance of the organization. So that is going to do what? To give you a lot of insight about the organization. And of course, entity premises and plant facilities. This is especially if you want to inspect assets, and yeah, you're going to see them in the premises. Then of course, observation. You can observe controls. How do we receive goods? How do we dispatch goods? How do we pay our salaries? So by you observing, you can actually get an understanding of how some of the things are done in this what? In this organization. Then analytical procedures. I hope you guys remember what analytical procedures are from a very, very first topic, which was introduction. And we said that analytical procedures, we are comparing financial and non-financial data, okay? And because we are comparing financial and non-financial data, that is going to help you to observe, to make some observations on the what? On particular trends that are within this organization. Things like gross profit, sales, things like trends, okay? Like if you've done an observation in this company over a period of time, you could actually ask, why is this thing moving like this? Why are we having the sales declining maybe over the last 5 years? It could actually be pointing to the fact that these guys are in the declining market. And if they're in the declining market, that poses a going concern risk. And you need to think about it critically, okay? They could be showing that maybe there's a lot of fluctuation in the gross profit margin. And we said that changes in the gross profit margin should be supported by either changes in prices or changes in selling prices or changes in the cost of purchases or the inputs into your business. So you need to be asking questions like, did we change our pricing strategies? Did we change our cost of inputs? And what does that mean from a what? From from a risk assessment perspective for the case of the what? For the case of the audit. So, and of course, you can review information from previous audits. You have carried out an audit in the previous years, so you can even look at those working papers and you get an understanding of the what? The business that you're doing. They could be your audit file. It could be the audit file of the previous auditors that have audited this organization, and you can gather a little bit more about the client. And of course, there's information that you get from client screening procedures. Before you take on a client, you have to screen them. You have to know them, know what they do. So even that can help you to do what? To firm up your understanding of the what? Of the business. And of course, there's information from external sources, like trade journals, government publications, the internet, consultants, bank rating agencies. Like, for example, most of the commercial banks are rated by some of the global rating agencies. So if you want to know what category of bank you're dealing with, how risky it is, how good it is, you could check out some of the information out there. Then, of course, discussion by the audit team. When you sit as a team, you will try to brainstorm about the client and what are the potential risks that come along with the client. If I sit down with Peruth and we discuss as two, we could think about Dennis's business and know what potential risks are. I could ask Peruth, what do you think could go wrong in Dennis's business? And then Peruth is going to say, I think Dennis's business is maybe in the education sector and the schools have been closed up to 2022. So there's a risk that Dennis may not be having sufficient working capital to keep his school alive up to next year. That's just brainstorming. Someone else could bring another perspective of R because maybe Dennis's school has been closed for the last 2-3 years. Is it 2 years? I think from March 2020, close to 2 years. Maybe he's lost all his good teachers, and once he opens next year, he has a risk of not getting new students. So that might pose a going concern risk. That's just brainstorming. You could discuss together as a team and see that the risk that the client is subjected to. Feruth could say that, I think Dennis got a loan from the bank and he might not account for it properly in the books. He might not disclose some of the things he needs to be disclosing that are relating to accounting for what? For borrowing. So you could brainstorm as a team, as an audit team, and come up with, some of the risks that could be affecting the client that you are going to audit. So,
now, if I may ask.
Yes.
Now, on a practical bit of it, since now you know what you are in this thing. Now, do you expect a school to be audited like for 2020 and 2021 when there was no activity?
Yes, what do you mean there was no activity?
Because I mean, there are no lectures, nothing was going on.
One, okay, that's a bit subjective, okay? They might not have revenue, they might not have expenses, but they will have balance sheet items. We have property, plant, and equipment. It needs to be audited and reported on. They have receivables. Maybe by the time they close schools, some people had not yet paid up the school fees. They have liabilities to pay. So it's not like there's no financial statements. I agree with you. Some of the line items might have significantly dropped, especially those that relate to day-to-day operations, but there's still financial statements to be audited for the school. Does that make sense?
Yeah, thank you.
Yeah.
CPA.
Yep.
Maybe in addition, for example, schools, from my experience, is you're actually going to go and audit to actually make sure that there is no activity going on, because it could have been a school, but now it's a totally different business or illegal business and all that. So you look at the financials to actually confirm that nothing is going on that is contrary to the expected activities that you expect in that business, more especially in this period. So yes, an audit is very important, most especially in abnormal situations where, not normal situations.
And maybe just to supplement that, the bit of not having revenue does not apply to everyone. We know that, for example, people have been doing online studying, so people have been paying, people have been doing exams. You're seeing universities, people are graduating, including CPA, people are going to sit exams a week after next week. So it could vary from one entity to another, but still there's going to be information that needs to be verified, that needs to be audited. I agree with you. We will have significant drop. Maybe a school which might have been making revenue of like 20 billion could now be having 1 billion or even 500 million, but there is going to be. They will have expenses. Not every school has stopped paying for their teachers. Some have been paying their teachers all through. So they will have whole payroll expenses to audit and stuff like that. Also, don't forget that we have even companies that do audit even when there is nothing happening. I myself have seen situations where we audit a company that does not even have any transaction, has not even started operating, but because they feel they need to audit their books and cement their financial statements, at least there's going to be share capital, because that one is a constant, which you need to verify, agree to the URSB report, and have that assigned off. There will be cash and cash equivalents need to be audited. The effort will be small, but that will be sort of very simple audit, very basic, and the opinion issued on those numbers. Not forgetting that in some of the jurisdictions, not only in Uganda, it is mandatory as long as you're a corporate entity to have an audit. There are some cases where it is actually like that you have to have an audit, and it is a requirement from the regulations. Okay, let's take a quick break of 5 minutes. We will be back at 7:31. Thank you. Okay, we are back. Let's take a look at this example. I hope everybody can hear me very well. Could you just confirm that you can hear me very well? And we take a look at this example.
Yes, you can.
Okay, cool. So, you are the audit senior of Rhino Land Company and you're planning the audit of King's Construction Company, KCC, for the year ended 30th of June, 2013. KCC specializes in building houses and provides a 5-year building warranty to its customers. Your audit manager has held a planning meeting with the finance director. He has provided you with the following notes of his meeting and financial statement extracts. KCC has had a difficult year. House prices have fallen, and as a result, revenue has dropped. In order to address this, management has offered significantly extended credit terms to the customers. However, demand has fallen such that there are still some completed houses in inventory where the selling price may be below cost. During the year, while calculating depreciation, the directors extended the useful life of plant and machinery from 3 to 5 years. This has reduced the annual depreciation charge. So from that paragraph, I want you guys to identify 3 risks in there and we brainstorm about them. Peruth, Denith, and Mrs. Baguma. Let's give it a shot.
I see a problem of falling in prices of houses, their stock. Hello.
What risk does that bring, the falling in prices?
It means there is a going concern risk.
There's a going concern risk.
Because it affects their business revenues.
Okay, that's one. Falling in prices that affects. Okay. Any other contribution or comment?
And maybe this changing of the depreciation from 3 to 5 years. I don't think it would be wise unless if there is an IFRS that really supports that, but I have not really seen it. To me, that would be also another issue.
Okay, yeah, that's a very good observation. You need to bring it out very articulately, but yeah, it's an issue. You can't just wake up and say the useful life of your assets has increased from 3 to 5 years. That has to be supported. Because initially I have been saying that I use my computer for 3 years. How should I wake up and why should I wake up and say that now I will use it for 5 years? These guys are just trying to misstate the depreciation charge so that their performance still looks good because they've had a difficult year. Any other observation?
Extend to the customers.
Sorry? Just say that again, I can't hear you well. Just say that again, I can't hear you well.
Extending of credit terms to their customers because of the prices of the houses that have fallen.
Thank you. Now, extending credit terms. Thank you. Now, extending terms to customers. Sorry, Faith, you need to mute your microphone. Your sound, your end has an echo. Sorry, Faith, you need to mute your end has an echo. Faith, could you just mute your microphone? Could you just mute your microphone? Okay, so I was saying that selling on credit, a lot of credit terms, sending significant credit terms to customers, they might end up selling the wrong people. So what does that mean? If you set the wrong people on credit, you will not recover this money. So there's a risk that some of the receivables are not recoverable because of the extension of significant credit terms to the customers. That is one risk. Our receivables might not be recoverable due to the excessive credit terms being extended to customers. Then depletion, we've already talked about that. Then they are saying that, however, demand has fallen such that there are still some completed houses in inventory where the selling price may be below the cost. What is the requirement of IS2 when it comes to accounting for inventory? IS2 requires us to record our our stock at lower of cost than net realizable value. So here we are having houses where the selling price is below the cost. Okay, so there is a risk that the inventory valuation of finished houses is not in line with IS2, since selling prices are seemingly going below the what? Below the cost. So the recommendation of what you would do as an external auditor is to make sure that you do a lot of NRV and cost testing to make sure that stock is properly valued in these financial statements. So I had three issues in this part, in this paragraph. Let's go to the next paragraph. The directors need to meet a profit target before tax of 150 million in order to be paid their annual bonus. In addition, to try and improve profits, KCC changed their main material supplier to a cheaper alternative. This has led to some customers claiming on their building warranties for extensive repairs. To improve their operating cash flow, the directors borrowed 300 million from DFCU Bank during the year. This is due for repayment by the end of 2013. Stayed with the risk feature in that paragraph. I still want, I now want 4 risks in this paragraph because we have 4 risks there. Can we all try to contribute? Thank you.
I see one of borrowing, yet the sales are not measuring up. You borrow, but the financing will be a problem, financing the loan.
Is it possible to put it in a very proper accounting or banking language? So the company acquired financing of 300 million from DFCU Bank. So there's a risk that there's going to be a high of interest burden on the what? On the company, which is going to affect its what? Liquidity. That's one. Then the other thing is that accounting for the loan might not be correct. The loan may not be properly disclosed in the financial statements. So, the next risk in that paragraph.
Is changing the material supply, and then the consequences that the warranties are being, how can I say it? The warranties are not maintained.
Okay. So there's a risk that the provision for warranty in the financial statements is understated because we are seeing a lot of people claiming for warranty because of the change in the material supplier. So what does that mean? When you're carrying out your audit procedures, you need to make sure that you audit the warranty provision more closely to make sure that there is no what? There is no understatement of the what? Of the warranty provision. Next risk. Guys, I talked about profit that determines a bonus. Bonus which is dependent on the profitability. That puts management on a risk, on pressure to overstate the what? The profitability. Because they can't be paid their bonus if they don't hit this profit target. So that brings a lot of pressure to overstate the what? The profitability in order to get the what? And the annual bonus. So as long as you see anything related to bonus and profits being dependent on one another, then that is automatically a risk arising from pressure to overstate the what? To overstate the performance. So okay, I think those are the risks that we had in that paragraph. Can we continue to the next part of the question? Can we continue?
Yes, please.
Okay, so we have these financial statements. Here we will just use analytics. I won't spend a lot of time. You guys know the ratios that we are supposed to be using. And definitely the question is going to guide you. They are saying that calculate 5 ratios for both years, which would assist the audit senior in planning the audit of KCC. Using the information above and the ratios calculated, identify any 5 risks. So the ratios that we have computed are gross profit, operating margin. If they've not specified, it's up to you to use the ratios that you think are going to do what? Assist you in assessing what? Risks. Normally, you're interested in profitability. That's why we have gross profit and operating margin. We are interested in efficiency ratios, which is inventory turnover, receivables turnover, and payables days, and then liquidity, because these affect what? The business. That's current ratio and quick ratio. And we are comparing 2012 and 2013, because remember the numbers that we had 2012 and 2013. That's the current year and the previous one and the previous year. So how have these ratios been changed? When we look at the gross profit margin, we can see it dropped from 46 to 44. We can see the operating margin dropped from 12 to 4%. We can see inventory days increased from 64 to 99, meaning you are taking 99 days to turn your stock into sales. Okay, so there's a risk that your goods can go bad, they can be obsolete when they are still in stock. Then we have inventory turnover. This has improved from last year. Then we have receivables days. You're taking longer to collect. You were taking 49 days, but now you're taking 91 days to collect. Then you have payables days. You were taking 55 to pay your suppliers, but now you're taking 83 days to pay what? To pay your suppliers. And the quick ratio has improved. Sorry, the current ratio has improved from 4.4 to 2.2. And the quick ratio has also improved from 3.3 to 1.5. And this is supposed to help you to do what? To analyze. Receivables. This receivables is going to be combined with the fact that they were extending significant credit to customers. Audit response, you're going to have to review recoverability of this what? Of these receivables and be comfortable. Inventory, we have seen the inventory days increasing from 45 to 97. Inventory days, no, from 64 to 99, okay? And of course, that is also explained by the fact that we had houses where the selling price had fallen below what? Below cost. So you need to do detailed cost and realizable value testing to make sure that your inventory is not inappropriately valued in the financial statements. We looked at, okay, there's a solution for this question. You guys can read in detail, but we've pretty much talked about it. We have talked about the assets just being overstated by understating the depreciation. So what are you going to do? Discuss with the directors and find out why they are changing the useful life of assets. Why are they extending it? Has it genuinely been confirmed that this useful life is long, or are they just trying to get away with it? Okay. And of course, what you've got to do is to make sure that you compare the useful life with the rate at which these items or these assets are being replaced. If you are saying that your useful life has increased from 3 to 6 or to 5, then I need to see that in the last 5 years, you've not replaced any of the assets. So you're saying that your computer is used for 5 years, then you shouldn't be buying new computers after every what? After every 3 years and disposing or dumping a few off. So and then of course we have the profit target. This is going to put too much pressure to manipulate the financial statements through use of provisions. So the only way you can address that is to be skeptical and of course also to review aspects of the financials that need a lot of what? Judgment and estimation. Things to do with provisions, make sure that you look at them very, very thoroughly, because that is where the directors could try to manipulate the financial statements from, since they want to hit a profit target. And then of course, we've looked at the change in the material supply that has increased the claim on the warranties. You need to review the level of the provision and make sure that the provision is complete and the provision is what? Is right and is sufficient. They borrowed from the bank a short-term loan, and maybe they need to be, one, it's current and it needs to be disclosed properly in the what? In the financial statement. So just read the financial statements and make sure that the disclosures are what? Are complete. And then of course, they could also have pledged some of the assets, so you need to check the loan agreement and confirm that. If there's any assets pledged as security, they are properly disclosed in the what? In the financial statements. When we look at the current and quick ratios, they have decreased, okay? And if the quick ratios are decreasing, the quick and current ratio, they are good if they are not very high. But also if they are very low, they are not good, okay? Good in a way that if they are low, they are good because it shows that you're using your current assets. But if it is like 4, it means you have a lot of idle assets. But if they're also dropping from 4 to 2, it also could mean that you are actually becoming liquid. Maybe you no longer have cash, you no longer have inventory, and the next thing you could be having liquidity issues. And therefore, there's need to do what? Proper going concern testing and make sure that the entity is not having going concern issues. And of course, we need to discuss with the directors. Up, we had already seen that the loan is due for repayment. I think it was 300 million or something. So they need to make sure that they have money to pay by the end of the what? By the end of the year. So, any questions before we continue? Please ask if you have any questions.
How do Hello?
Dennis, we had lost you. Just say a question again.
That how do you test for going concern in such a scenario where the director like
I think we shall look at going concern as a separate topic. Maybe we can pack that question for that. There's a whole list of procedures that you should carry out for you to confirm that the entity is a going concern. by looking at, do they have enough cash? Are they able to keep operating? Are their suppliers willing to keep giving them credit? Are like, are they having any legal regulatory issues? Do they have staff? Do they have the personnel? Do they have the products landed in the market? Do they have issues with competition? Like, there's many things that we actually take a look at when we are doing a going concern testing. We look at that and audit completion. So, once we assess these risks, we have to respond to these risks. And we will respond at financial statement level. And okay, the risks are of two categories. There are risks that are at financial statement level, or those that affect the financial statements as a whole. For example, a head of finance not being qualified, it is not linked to a particular assertion. I believe you guys still remember the assertions and the explanation we attached to it. This is a risk that is going to affect the entire financial statements. Everything can go wrong in the financial statements if the process for preparing them is not what? It's not okay, or maybe there is a competence issues. However, there are also risks at assertion level. If, for example, we do not perform a bank reconciliation statement at the end of every month, that is going to bring a risk at an assertion of accuracy of the cash and cash equivalents only if that is the only shortfall that we have. If we have a risk of maybe expenses are not approved before they are incurred, we could have a risk of unauthorized expenses happening in the financial statements. Okay, so the risks can vary in the version, and how we respond to them is going to also vary. Okay, how do we respond to risks at financial statement level? We said these are risks that affect the entire financial statements as a whole. Okay, some of the things that bring in these risks are related to, like, preparation of the financial statements, selection and application of accounting policies, IT general controls, and the control environment. If there are risks that affect the entire financial statements, how do we address them? They are not linked to a particular assertion, and therefore you cannot say that we will do this on this particular aspect. But there is the general things that we can do to make sure that we address the risks at financial statement level. Assigning more experienced staff. Generic risk, generic response. If I assign people who are experienced, people who have specialized skills, we are going to be able to nail this risk. Maintaining professional skepticism. Still, this is a general risk, and we give it a general response. Let every team member be skeptical as they carry out this audit. Then making audit procedures to be performed more unpredictable. If it is a risk of fraud, which is going to affect the entire financial statement, then it's very important that we do what? We bring, we make sure that our approach is not predictable. Increased supervision. When you supervise this audit very well and very closely, it is going to increase your ability to address the risk at financial statement level. And then, of course, making general changes in the nature, timing, and extent of audit procedures. It is very important that you change the audit strategy as and when the audit progresses, depending on the what? On the need, and of course, depending on your understanding of the entity and its environment. Sawa. So, how do we respond to risks at assertion level? Risk at assertion level, we say that these ones affect particular classes of transactions, account balances, and disclosures. Okay, These are risks which are linked to particular areas of the financial statements. For example, it could be a risk of maybe impairment loss, which is going to affect only the valuation of the what? Of the assets at the end of the what? At the end of the year. It could be a risk relating to inventory at the end of the what? At the end of the period. I just gave you an example of a risk where we did not prepare financial statements, and therefore we have a risk of having an incorrect cash and cash equivalents. So you are going to have to carry out or design and carry out procedures. You're going to have to perform procedures which are responding directly to the risks that you have assessed, the risks of material misstatement. If, for example, I know that they don't do a bank reconciliation at the end of every month, my procedure is going to be maybe to prepare one for myself or to request management to prepare one, and I review it at the end of the what? As I'm carrying out my audit. So if it is a risk at an assertion level, then you're going to have to tailor make your procedures depending on the risk that you have assessed on that particular assertion. So responding to risk at assertion level is going to vary depending on the what? Depending on the assessment that you have made when you're doing what? When you're doing your risk assessment. So, are we together? Do you have any questions, comments, or additions before we continue? Any comments, guys? There's a small note on test of controls, and basically test of controls, we carry them out, to evaluate the effectiveness of the controls in preventing, detecting, and correcting material misstatements at assertion level. So this is one of the ways of responding to risk at assertion level. You can actually carry out test of controls relating to these particular assertions. You have assessed the risk, look at the controls that are going to be related to this particular assertion that you have assessed, okay? And of course, you're going to have to carry out substantive procedures, and substantive procedures, you're going to do this for each particular class of transaction, for each account balance, and for each of the disclosures. Normally, for substantive procedures, they have to be carried out irrespective of what? Irrespective of irrespective of the risk assessment and the likes. So, any comments, any additions, any questions?
So substantive procedures at financial level or assertion level?
Substantive procedures at assertion level. Yeah. Okay. I'll beg to stop here, and next time we will start from fraud. How to deal with fraud in the audit of financial statement.
CPA, kindly help us share this. The internet has been so terrible, most especially for me. If you can kindly share the recording.
Okay, I'm going to share with you. Yeah, I'm going to upload and share with you the link to the recording.
Yeah, even the old ones you promised to share, we have not received yet.
Okay, well, I'll check with Bolson on that. He's the one who did the recording in the previous classes. I'll check with him and then update you guys.
Thank you so much.
Okay, all right. Thank you very much, guys, and have a great weekend.
Next time to you, Sue.